Hello, my name is Abdul Mubarak and I would like to summarize my advanced accounting notes for week 9 about business combination. Business combination is the union of two or more companies which separated into one economic entity or investment. There are three types of business combination: is horizontal integration, vertical integration, and conglomeration. And also there are two forms of business combination. The first one is merger. A business combination in which one corporation takes over the operation of another entity and the entity goes out of existence. And the second is consolidation. When a new corporation is formed to take over the assets and operation of two or more separate business entities and dissolves the previously separate entities. And there are reasons for business combination is cost advantages, lower risk, fewer operating delays, avoidance of takeovers, acquisition of intangible assets, and other reasons. Well, the accounting for combination of business combination is using two methods. The first one is pooling of interest method, which no longer used, and the second one is purchase method, which are recorded based on the price of the acquisition, such as purchase using cash, fair value for non-cash, and the fair value of shares if purchased with shares as well. And also, there are two types of costs, is direct costs and indirect costs. For example, about Pop Corporation and Sun Corporation. And below is the statement of financial position of Sun Corporation in acquisition dates. Which assets such as cash, account receivable, inventories, land, and etc. And liabilities and owner's equity. So we are going to make the journal entries for Pop Corporation. The first step is journal for net asset acquisition of Sun Corp. So we are going to make the journal entries: equity investment in Sun Corp, common stock, and additional paid on capital stock. And we are make the entries about investment expenses, additional paid on capital stock, and cash. And the step 2 is we are going to close the entries make the closing entries by Sun Corporation. By closing the accounts in the statement of financial position and recorded at book value. The journal entries is owner's equity, liabilities in debit and credit on cash, account receivable, inventories, land, building, plant, and equipment. And the third step is we are going to calculate the investment purchase, where equity investment for Pop Corp is 1,800,000 and net asset of fair value of Sun Corp is 1,600,000. So we are get the difference is goodwill 200,000 in debit, but if the difference is credit, so we are going to make the journal entries about gain on bargain purchase. So the journal and the step 4 is journal entries for Pop Corp to take over the Sun Corporation at fair value. So we are going to make the journal entries in debit, cash, account receivable, inventories, land, building, plant, and equipment, and goodwill. And credit is owner's equity and liabilities. And the step 5 is we are going to input Sun Corp's net assets to Pop Corp's statement of financial position, just like this. So I think that's enough. Thank you and goodbye.